We're going to continue our discussion of pensions that we left off as the last video. We ended with this statement and changes in fiduciary net position, which measures additions and deductions to any public pension fund. They're not revenues and expenses. They get coded as additions and deductions. Okay, then we have our schedule of changes in net pension liability and related ratios. So one of the supplementary materials that governments are required to include about their defined benefit pensions is a 10-year information. So they need to, what is their total pension liability? What are the changes in their pension liability? How much is the contribution from payroll? And also like the total pension liability minus plan net position. So basically what needs to be shown in these documents is that governments are solvent and are able to cover these pensions when they come due, that they are taking care to save for these. You can think of some of these pension liability as like a debt service account, where we're planning ahead to make sure that we can pay our future pension liabilities. So this is an example of the schedule of contributions, where we have 10 years that we give information, and we have the percent of covered payroll. So we have that actuarial determined contribution. So what the actuarial determined contribution is look at, what is the age of the employee, what is the age of retirement, how many years do you have to save for retirement. Of course, the less number of years that you have until retirement, the less that is, or the more that needs to be saved, versus if you're starting younger, you need to contribute less because you have a longer time to put funding away. Okay, then a schedule of investment returns. So what is the return on your pension plan investments? So we already talked about investing those debt service funds and stuff like that to earn interest and dividends and such on them. And so this is the same with these pension accounts, where we have savings set aside. As I said earlier, a pension fund is much like a debt service fund, where we would invest it and earn on it for future payments. Okay, these are some examples of the journal entries for an employee retirement plan. So we have interest receivable, and then we have member contributions and employer contributions. So often in retirement plans, there's both a employee contribution and an employer contribution. And that gets defined about what, how much is which. Often member or employees can declare to add more than what their defined amount is. So for example, if an employee has a defined amount where they have to add 5% of their salary every month, they can elect to take more. So they could elect to take 7%, but the employer contribution never changes as the percentage of what is being put in. And then this last journal entry shows deductions for payments to people who are retired and people who are on disability. Okay, some other examples. We have terminated employees. This example, refunds to terminated employees. So I had mentioned that when we looked at the statement of additions and deductions changes, but that when people leave, they get their contributions to retirement refunded to them. If they've worked there a certain number of years, every entity sets what that number of years requirement is called vesting. If they have worked there a certain number of years to where they're considered vested, then they would also get their employer contributions. Otherwise, they just get their own contributions refunded to them. So other journal entry examples of our investments, so investing in commercial paper, stock, and bonds. So if you saw in the statement of net position, you would see that they had a mixed portfolio of stock, bonds, and commercial paper, with a higher investment in bonds than they did in stocks and commercial paper. Some other, these are the closing entries for the end of the year. And then we would be set to start the next year. After we close our entries, then of course we can make our financial statements. Okay, our employer's pension accounting, we have to record those in the fund and in the government-wide financial statements. Of course, what we're looking at is what is the pension liability and any pension expense or expenditure that we're paying out. So this would be, we're going to look at the government-wide financial statements in the next chapter. So next week we'll be talking about those. Okay, our net pension liability. So this is unfunded pension liability, which is the difference between how much we need to pay out and the amount that we have saved. Of course, we do not want there to be a very large number here because we want to be able to meet our debt obligations in the future. Okay, we've talked about some pension expenditures, and really this is the amounts paid to the pension plan by the employer, and then the amount that's expected to be paid out in the next year. So when we're looking at our government-wide statements, what we're going to include in the pension expenditure is both the amount that the employer, the government, contributes to retirement savings accounts, and also these payments to current people who are retired, so those annuity payments. Okay, so when we get that pension expense for the period, these are the items that go into it. So we have a service cost, usually related to the management of our investment account. We're going to have interest. We're going to have plan changes. So we've added employees, we've deducted employees, changes from our investments, projected earnings on investments, and any portion of deferred inflows and outflows. We also have other post-employment benefits that businesses need to think about. These include things like healthcare costs, life insurance, long-term care, among others. Many employers offer options for employees to give payroll contributions, to have disability plans, life insurance plans, and nursing home insurance, so that long-term care, and they can have others, dental care, health care, and other types of contributions. Normally this is very similar to anything of defined benefit pension plans. Of course, anything where we are creating a future liability where we may have to pay out, we need to think about our accounting treatment of that. Okay, this is the end of chapter 8. As I said in chapter 9, we're going to move to government-wide financial information.